Good morning, everyone. This is Marshall Gidler bringing you the morning comment for March 6th. The dollar was generally higher against most G10 currencies Friday morning, despite disappointing U.S. data. The key reason is probably the monetary divergence between the U.S. and Europe in the first place, but also divergence against most other countries as well, which was emphasized yesterday by ECB President Draghi's explanation of the details of Europe's quantitative easing program. I won't go into detail about the ECB press conference, because that was yesterday's news. I do have some comments about it on my commentary on our website, however, so if you're interested, please take a look at that. Now, the dollar's strong performance came in the face of more negative surprises as initial jobless claims edged higher and U.S. factory orders fell for the 6th consecutive month, contrary to expectations of a rise. U.S. economic news continues to disappoint, while European economic news continues to surprise on the upside. It doesn't matter, though. It's the divergence in monetary policy that matters. San Francisco Fed President Williams, a voting member of the FOMC, yesterday said that mid-year may be time for, quote, a serious discussion about raising interest rates as the labor market nears full employment and inflation rebounds. Now, dollar-yen's opening in Europe today back above 120. This is the third break of that level this year. The rise is significant given all that we've heard recently from Tokyo are comments about the negative impact of the weak yen. The previous two times dollar-yen went above 120, it wasn't able to maintain it for very long. So if the pair can stay above that level for today, it may signal a new trading range. Now, later today, it's non-farm payroll day. Yay! The market consensus is for an increase in payrolls of 235,000 in February. That's down from 257,000 in January, but would only be a return to normal after the astonishing increases in recent months. At the same time, the unemployment rate's forecast to have ticked down one notch to 5.6%. On a less positive note, the rise in average hourly earnings is expected to have slowed a bit on a month-on-month basis, but remains stable at 2.2% year-on-year. Even if the market gets worried about the stagnant wage growth and sells the dollar, in my humble opinion, the setback should be limited, as the dollar's trend going into the employment report is almost more important than the employment report itself. Given the strong underlying demand for dollars, any disappointment on a weak report is not likely to last long, as buyers are likely to take advantage of any dips, in my view. As for the rest of the indicators, Eurozone's final GDP for the fourth quarter is forecast just to confirm the preliminary print of plus 0.3% quarter-on-quarter. Canada's building permits for January are also coming out. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gidler, head of Global FX Strategy at IronFX Global, wishing you solid trading.